You're listening to Smart Moves with your hosts, Ann Riley Caldwell and Matt Wilson.
Welcome to Smart Moves, the podcast where we help you make confident, strategic choices about real estate and mortgages and moving in Middle Tennessee, and we make it as easy as possible. I'm Matt Wilson, the co-host of the show and mortgage guy, and I'm here with Ann Riley Caldwell.
Hey, I'm Ann Riley. I am not your ordinary agent, real estate consultant here in Middle Tennessee. And today we have the honor of having Matt explain to people the truth about pre-approvals in the mortgage world. So Matt, tell us a little bit about what a pre-approval is, what a pre-qualification is, what being underwritten means. Just kind of lay of the land for us here.
Absolutely. So basically, here's the thing. You've got three levels of what people commonly just refer to blanket as pre-approvals. So the first stage of all of this is pre-qualified. That's what it is whenever you get the thing in the mail and it says you can have a $10,000 credit card or whatever else that comes to you that day. That's also what it is whenever you go online and in 5 minutes or less find out that you can buy a $500,000 house or what have you. But the thing is, with a pre-qualification, nothing's validated. It's basically just what you think about you. And with that being the case, you're just kind of playing with fire if that's all that you're rolling out with. You could potentially get into a situation where you thought that you made, $100,000 a year. I've actually never talked to a self-employed person who didn't think they made $100,000 a year. Their tax return said otherwise. But then once we get into the meat and potatoes of things, you don't qualify for the house that you really had your heart set on. So to help prevent that, the second level is pre-approval, which should mean, some lenders use it interchangeably, but if they're doing it honestly, it should mean that you are validated. We've seen your income and assets and seen your credit, and you've been run through the automated underwriting system. So at least the computer says that you're approved. It's just a matter of human validating all of your income and asset stuff after that. Then the highest level that you can get that's not just going and writing a check for a house with cash is to be an underwritten, fully underwritten pre-approval. That's where we try to take as many people as we can before they get into contracts that they have problems with. But basically that means that the human that's going to approve you to buy the house at the end of the deal goes ahead and approves your side of things at the beginning. Now it's just up to the house to make everything work after that.
Yeah, and one of the things I love, Matt works for a company called New American Funding. And I've worked with multiple lenders, both representing buyers that I represent on the real estate side, as well as working for a couple builders and I have seen all kinds of pre-approval letters come from that side, and representing a seller, which also is great knowledge for me when I represent sellers just selling their own home, because when people come in with certain lenders, I can kind of give them some inside scoop on whether or not those lenders actually did a pre-qualification, they actually did a pre-approval, and almost nobody does an underwritten situation by the time that somebody writes an offer on a house. So honestly, it's a very rare thing that I see, and it's one of the things that I love that Matt consistently does. Is make sure that when I take a buyer out, in fact, literally in between us recording, we filmed more than one today, podcast episode, I literally just sent a text. We're in a multiple offer situation here in June of 2025, and I just sent a text and said, oh, by the way, because we just did a podcast about this topic, just touching on it, that the buyers are actually pre-underwritten or underwritten. They are not just pre-approved, which means they are more than solid. And that may very well be a huge tipping point as to whether or not their offer gets accepted. So thank you to Matt for being diligent and for New American Funding to have a process to make it happen. usually within 2 to 4 days once everybody gets their documents in, gets the questions answered and all those kinds of things. So it's really fast. And then as Matt mentioned, at that point, it's just, what do the terms of the contract say, and does that match up with what you're pre-underwritten for? Which are the things that he and I carefully walk through together and with anybody we're representing to make sure that when we make an offer, he knows, because he probably gets tired of me sending over the MLS sheets with the details of what offer we're thinking about making, just to triple check that there are not any apparent issues or anything that we've forgotten, or the $200 a month HOA is not going to blow it out of the water, because neither one of us want to tell buyers that, hey, we wrote an offer that you could never actually close on. That's not fun.
Yeah. So far, I think we're both batting 1,000 on not making anybody homeless, so that's a good thing.
That's correct.
So, yeah, that's the biggest thing, though. That's the biggest mistake that I see people make whenever it comes to trying to get pre-approved, is that they stop at pre-qualification because it's easy. I mean, it's super easy to just tell some guy over the phone or an internet form that you've made $100,000 this year, you've got a house to sell, and that you're going to net out $200,000 from the thing, and that you're going to put all that down on your next house. But what's not,
you think your credit score's at least 705.
Yes, and everybody's got amazing credit. Yeah, always.
Because Credit Karma told me.
Right, exactly. The problem is in those situations, more often than not, like I've gotten involved after things have gotten squirrely for people. Like they hear about me after they've gone and stepped in it, essentially, and now it's my job to clean it up. But when that happens, what usually has happened is they haven't had their income checked out, and when it came down to the actual what the underwriting guidelines would allow to be counted, they weren't making what they thought they were. Maybe they were in real life, but underwriting guidelines in real life don't always coalesce with one another. That's a big word. Come together, just in case, thesaurus today. But ultimately, that's the thing that you got to watch out for. Here's the picture with mortgage. If you've ever watched Law and Order, like the whole thing, or CSI, it's all about gathering up evidence, and they got to figure out how to prove that Bob the Builder killed somebody or something like that. We have to prove that you made as much money as you said that you make. The same way, we have to prove that your bank account has the amount of money that you said it has in it. And we have to also prove that amount of money didn't just appear there yesterday because you dug it out from under your cushion or your backyard hiding spot. So, while it may seem easier in the moment to go get the 5-minute online approval, what you're setting yourself up for is an awful lot of suck the rest of the way. It's going to make most of the rest of the process, unless you really are just a salaried employee that has lots of money set aside in a retirement account or something, savings account to pull money out of, and really do have great credit. Like, it's going to be a very hard time to actually get you approved based on just what you think it should be.
Well, and there's so many factors that go into it. Credit scores are huge as to getting you approved and what loan type you can get. And also, one of the things is, in fact, they just asked me, because I've been a little bit busy today trying to get this podcast done, but most of the time in Middle Tennessee, when you make an offer, the listing agent is not going to tell the seller to take it seriously without that letter from a lender saying that you are pre-approved, or in this case, underwritten. So how long do those letters often last? Like, can you just run around with them for like the next 12 months and be like, hey, I can still buy a house? Oh
yeah, totally. Not really. Not at all. Actually, I was talking to my wife the other day, who is also a real estate. I mean, I talk to her every day, but this conversation happened the other day. She's also a real estate agent, and she had somebody send her a 12-month-old pre-approval letter for a tour of a house. So she had to direct them back to their lender and have them try that again, so that they had one from this year and not last. Pre-approval letters are basically good as long as your documents are good. So what I mean by that is your credit's generally going to be good for about 120 days. So it gives you about 90 days to shop, 30 days to close if you need it. Your pay stubs and stuff, those are going to be good for about 30 days. Same goes for bank statements. Obviously, unless the year rolls over, W-2s are going to be good for the next year. So, worst case scenario, in 4 months, we repull credit, refresh everything, grab some more pay stubs, and keep trucking. It's not the end of the world. Matter of fact, I always recommend that if anybody even thinks that they want to buy a house sometime in the next 12 months, let's get you pre-approved and just keep you that way between now and then. Because inevitably, what's going to happen on everybody's pre-approval, mark my words, you're going to find the house that you really want to have the day after that you told me you didn't want to re-up your pre-approval. And that's going to happen to be like a holiday weekend Sunday every single time. I'm going to be probably in the lake or ocean or something like that. And you're going to be sad because I can't re-up your pre-approval letter that day because I'm nursing the wicked sunburn that I just got because I don't sunscreen the way that I should a lot of the times. So, with that being said, let's protect all of us. We'll put some SPF on your pre-approval as well and just keep it rolling.
There you go.
It doesn't cost you anything extra. It didn't cost you anything to begin with.
Well, and I will say occasionally Matt does take off, but he's around a lot more than most loan officers, people, branch managers, etc. are. So, not always just 9 to 5 and then peace out. So
it is never 9 to 5.
Monday through Friday. I know,
the only
right?
reason
with a lot of people they are. That's why I tell people if you need to talk to somebody after 5:01 p.m., don't go to a bank.
Yeah. Now, if you want to talk to me after 9 p.m., let's not do that because I'm a grandpa at heart and I go to bed about that time. But if you want to talk at about 5, I got you. We can do that at 5 in the morning.
I'm the opposite, by the way. So you talk to him in the morning, tell me what he said, and then I'll be here at 9 p.m. So it works great. You get pre-approved in the morning, I'll help you at night. So it's awesome.
Yep.
Yeah. So with credit scores, it's so misunderstood. There's so many topics, but people think that Credit Karma is amazing. Why don't you tell people a little bit about what is authoritative when it comes to credit scores, and if they really want to know what theirs is, what's the best way to do that?
Yeah, so first off, here's the truth about Credit Karma. Credit Karma is literally just a lead getting machine for lenders and banks. That's all they exist for. So whenever you're over there thinking they're giving me my credit score and stuff, they told me that this place is the cool place to go get a credit card at or the best place to get a mortgage at. Spoiler alert, even my own company. And I've closed leads that have said, Credit Karma recommended you guys. They recommended us because we paid them to recommend us. So don't get caught up in all that, okay? Secondly, they're estimating what your credit score is, and they're doing it in real time. So I'll talk to people and they'll say, hey, I just paid this credit card off and my credit score just went up 75 points today. And I'm just like, sweet. Today? You paid the credit card off today. What's your source for that? They're always saying it's Credit Karma. Okay. Well, your real credit score is not going to get updated in real time. It's going to happen roughly every 30 days-ish. And we don't really know when each of your creditors is actually going to report your payment that just happened. So that algorithm that's actually running the show is going to be completely different than what you see on Credit Karma. Sometimes that's to your benefit. I've definitely talked to people that it's turned out to be a situation that they had a higher credit score than they thought they had. But more often than not, for whatever reason, you got a lower credit score than what Credit Karma says. I don't know what it is other than they just want to gas you up. My favorite part is when people argue with me as if I get to control your credit score. And when that happens, I'm just like, I don't control the weather. I don't control your credit. I'm just telling you what I got here. And with that, here's the thing too. I talk to people all the time that want to have their credit score just sparkling clean and absolutely spectacular before they're willing to do anything. But the thing is, in my opinion, waiting to get your credit pulled and waiting to get your pre-approval done until you feel like you've got you in good shape, it's kind of like waiting to hire a personal trainer until after you feel like you're in good enough shape to hire a personal trainer.
We all do things like that. We all wait like it's
100%.
like it's going to be better, and we're not quite as embarrassed. And it's crazy because people get embarrassed by their credit score, especially if it's low, obviously, or if they just think it's low, or if they don't even know what low is. So, and I'm like, don't be embarrassed. It's like everybody has one, and we got to deal with the situation, whether it's high or low or somewhere in between. Until we know what it is, we can't really give you any advice or tell you when you're ready to go look for a house.
Absolutely. And it doesn't have to be nearly as high as you think it does to qualify to buy a house. You can technically buy a house with as low as 500 for your credit score. Now, we're going to talk through pros and cons of that whenever we're having a conversation, if that's your situation. But I've done it several times. I mean, there's plenty of buyers that I've helped get into a house with super low credit. If you wanted to do some down payment assistance, like those start at 580 for credit. So like you don't even have to have great credit just to get zero down on a house even. There's options out there for credit in all tiers. Now, the biggest thing though that people miss on credit is that most of the time they want to pay things off to build their credit score. You don't want to do that necessarily, because sometimes whenever you pay a credit card completely off, for example, it's going to hurt your score relative to just leaving like $10, $100 or something like that on there. So that furthers the whole thing of like, talk to me first, talk to a lender first, because we can help run simulators on your credit. And oh, by the way, we also do soft credit pulls to begin with. The only time that we do a hard credit pull is when we get a contract, or if we're in a situation where your credit is a little bit on the sketchy side, and I want to make sure that we're not going to run into problems when I pull the other couple of credit scores. But if things are fair to middling to great, you're only getting a soft pull done, doesn't hurt a thing, doesn't cost a thing, and gives us what we need to know in order to get you into your next house.
So circle back around, because that was one of the things I was going to say, because people tell me a lot about their finances when I first talk to them, which is great, because then I can give them at least some information and then pass information on, etc., and hopefully encourage them to go ahead and talk to you. One of the things that breaks my heart, there's many in the world of real estate and finances and life, is when people say to me, "Oh, I'm just working on my credit by myself," and I'm like, "Oh." Because what I've seen, and I'm going to let you elaborate, is one of the things that you just referenced, but people paying off the wrong things, people digging up things from the past that no longer is hurting them because so much time has gone by that it's, I would say, kind of a moot point or very little impact. And they go and they start making payments towards it. And I don't know all that you know, but I know enough to go, no.
Yeah.
Please just stop what you're doing. Stop what you think is best for you. Stop what you think is going to help your credit score. And please talk to Matt, who can actually run those simulations for you and can actually give you the details and actually put together a real plan that tells you exactly what to do, exactly what not to do to get you to the credit score that you're trying to get to do what you're trying to do. So go ahead and tell us a couple of those instances where you've watched people just do things that you're just like, oh no, that was not good. It sounded good.
Yeah. So I'm trying to narrow it down because it's about every day that I have these conversations. All right. So here's the first thing that I'll say. When it comes to credit, you need to think of it a lot like dieting. Over the years, what's healthy has changed substantially. What's financially healthy from a credit standpoint kind of has too. And oh, by the way, a lot of the information that's conventionally known out there is not probably the right information when it comes down to it. So, like on the dieting side of things, you remember everything was low fat for the longest time, and then it flipped to low carb for the longest time, and then now we're to like high fat is the way that you get a six pack apparently. I
like that better.
When in reality it's probably, what's that?
I said I like that better.
Same here. I can much better deal with that. Let me tell you what, I'll throw down some bacon. But when it comes down to it, it's not a thing that is a one size fits all for diet, and it's also not quite one size fits all for credit. But the biggest things that I see people make the mistake on, first off, is paying things off. Yes, you want to pay things off over time, absolutely. But if you get like a young person that's got a car loan because they needed to get their first good car or whatever, they'll be rushing to pay that thing off as fast as they can. But you have to remember that credit scores are there to help the bank predict how you're going to pay things for them. So if you're paying it off as fast as possible, that doesn't really help the bank understand how you're going to do over a long time horizon, like, say, a 30-year mortgage. So with that being the case, you wind up in a position where, oh, cool, I paid my car off in 6 months. I should have great credit. The problem is you paid it off faster than your credit actually began to build, and you may not have a score at all. So that's a common one that I see. The next thing that I see people do a lot is they'll see on Credit Karma that they've got these collection accounts or charge-offs that they weren't aware that they had until they decided to pay attention to Credit Karma. The thing about those is a lot of the times it's kind of like ripping a Band-Aid off or something. So they kind of age out over a period of time. Sometimes whenever you pay it, it's actually going to reignite the activity on that account, make it fresher on your credit algorithm, and tank your score, even though you were doing the right thing. That's not to say that every time you don't want to pay some things off, just we need to talk about it first. You don't want to go chopping off your own leg accidentally ahead of time. Then next piece is credit cards, and this can go both directions. So the most common piece of advice that I give people when it comes to building a credit score up is to get a credit card. The thing about a credit card is it's a power tool of credit building. And the same way that I can build a house a whole lot faster if I've got electric, a circular saw and a nail gun and things like that, I can also shoot myself in the foot with a nail gun a whole lot easier than a hammer and nails too, right? You can do the same thing with credit cards. So the biggest rule of thumb is you want to keep it under 30% of whatever's available. What I mean by that is if you got $1,000 limit, $300 is your limit. That's where you don't want to go past. But wait, there's more. You want to make sure that actually that's just taking it to a point where it's not going to negatively impact your score. If you keep it below 10%, that's where you have the highest likelihood that it's going to positively impact your score. So the easiest way to build credit for somebody that's kind of starting things out is to get a credit card with a low limit, put Netflix or Disney Plus or something on it, set it on auto pay, and forget that you got both of them. That way you've got a little something showing up every month on your balance. It's an active account. But you're also never going to run it up over 10% of what the limit is.
Got it. Yeah, there's just so much to all of this, and not talking to a professional sets people back so much, and it keeps people from, maybe being able to buy a home in 6 months, and instead it's going to be 2 years or 3 years or 4 years because they did things they shouldn't have done, even though in theory it was a positive thing. Like, I'm paying stuff off. Like, I went and paid something from 6 years ago. Okay, no.
Yeah.
So anyway, yeah. Just because it sounds good, just because you can, doesn't mean you should. So anyway, yes, definitely want to get advice. So the other big thing that we talk about where loans are concerned, that people ask me all kinds of questions and also never know what this number truly is something we refer to as DTI, debt to income ratio. So give us a quick synopsis of what the debt to income ratio is and why it's important.
Yeah, so most people think their credit score is the most important part of getting qualified for a loan, but it's actually your debt to income ratio. Usually if we've got credit issues, we can fix those pretty quick. Debt to income ratio is the hard one. All that your debt to income ratio is it's dividing your monthly debts by your monthly gross income. Notice I said gross income, though. It's not what you take home. It's what you get before Uncle Sam gets involved. So we do give you the benefit of that. But the thing is that the whole reason we do that is to figure out if you've got money left over. My goal isn't to put you in a position where you buy a house and the next thing you know, you have to live off ramen noodles and beanie weenies for the rest of your life. Checking your debt to income ratio is the way that we do that. So in general terms, you want to have it below about 45%. There's absolutely options out there that are going to let you go well in excess of that. But a good rule of thumb is to keep your DTI under 40% or 45% rather.
And most of the time, in my layman's terms, is I tell people it's anything you can't just call tomorrow and cancel. For the most part, is that correct? Like debts that you can't just get rid of, like your cell phone you can get rid of. There's certain things that, you don't have to have that don't count.
Yeah, it's debts, not bills. So it's things that you legitimately owe money on that aren't just for a recurring service of some sort. So
two of the biggest ones, let's just talk really quickly about student loans, because that's been in the news a lot lately, and how those do or don't factor into everything, and if there's been any changes to that, etc.
yes. So if you're watching this right now and you got student loans and you're like, they're deferred, I want you to pause this video, get off YouTube, and go double check your email and make sure that they're actually deferred right now. Because what happened as a result of COVID was student loans got put in deferment for like 3 years. And that deferment period ended in September of 2023. After that, there was about a 12-month grace period through October of 2024 where you didn't have to pay it. There was no penalty or anything, but it was technically out of deferment. I went ahead and set mine up on repayment at that time frame. Interest was already starting to accrue at that stage again. So I knew I was set at that stage. But a lot of people didn't. They didn't get proactive on everything. And they wound up in a situation where in January, they were suddenly 90 days late on their credit reports for their student loans. And that really, like I saw multiple credit reports with people that would be at, formerly they were probably 100, 150 points higher than where they were whenever we got there, just because they had the student loans do that. So you want to make sure that your student loans are being repaid if you have them. The next piece to factor in there with that to income ratio is if you are in deferment legitimately with your student loans, we still have to count a payment. So it's always best to put it in an income driven repayment plan. I won't say always. Sometimes it may not be, but most of the time it's best to put it in an income driven repayment plan to get you the lowest possible monthly payment, because all we care about is the minimum payment. I've seen situations where people with $200,000 in student loans had like a $50 a month monthly payment. That's fine. We can count it that way. But if they were not on that income-driven repayment plan, they would have had probably a house payment for their student loan payment. Ironically, they weren't a doctor or a lawyer or anything. They were, they just took the scenic route through college, I guess.
There you go. And then one other big thing that factors in, as I mentioned, I think in this podcast, things that break my heart, is people who get these car loans that are $700, $800, $900, $1,000 a month, and they've done it within like a year or less of wanting to buy a home. Sometimes the month before they decide to get pre-approved. So tell us what car loans do for you and when you should get a car loan.
Yeah. So, ouch, car loans. Here's the thing. I am not preaching from a pedestal on this one. I have made this mistake myself. I'm paying off this mistake right now times 2. So every $65 of car loan you're paying changes how much house you can buy by $10,000.
Wow. Say that again. Oh, hold on. Go back and repeat that.
Every $65 in car loans that you're paying every month is going to change your qualifying amount for a house by at least $10,000. So you got a $650 car payment, probably a sweet ride. My $650 car payment's a nice ride. But it also takes you away from about $100,000 of ability to buy your next house.
Wow.
Yep. And also, just so that we can say this while we're on the topic, don't go buy the new car after you get qualified to buy the house. Get the house and get to closing either. I've seen that happen before. People decide that the new garage needs a new car in it, and now they're going to have to sleep in the car, because until you're closed and funded, any new debt's going to count in the mortgage application, and we're going to find out about it.
So the lesson is house, then car.
House, then car.
Then car, house, then car. Not
Yes.
car, then house.
Right.
For most people. Some
Yes.
people, it doesn't matter. Some of our clients have a lot of money. They can buy 47 cars and a house. But for most people,
Those
it's
people
house,
probably don't have a
then
car.
car.
Yeah.
Yeah, that's true.
Yeah, exactly. And, be reasonable with your car, unlike what I did. Like, I am not preaching from a high horse here. Like, I've made some horrendous car loan mistakes. Don't do that. Don't be me.
Yeah, so those are probably, don't you think, the two biggest things for debt to income purposes is student loans and car loans?
Absolutely. All day, every day. And the other thing, too, is 0% interest doesn't always only cost you 0%. Same principle applies. I see people all the time with the 0% lawnmower or whatever they just bought. They just absolutely don't want to pay off the lawnmower. Well, that $200 can turn into $30,000 or $40,000 in house they can buy, but then they also want to buy more house. So choose your battles there.
Oh, wow.
Saving 0% interest on a $2,000 loan is not that big a deal in the grand scheme of things relative to buying a house where interest is hundreds of thousands of dollars.
Awesome. Well, we are here to help you on your journey to buying a home, from the real estate perspective, from the finance perspective, maybe life perspectives, depending on what questions you ask us. But for right now, we're here to help guide you here in Middle Tennessee and even throughout Tennessee. And Matt can actually work in other states, but we're based in Middle Tennessee. But we're here to help you in every way. I'm Ann Riley Caldwell, not your ordinary agent. And you can go to my website, notyourordinaryagent.com. 615-930-0313 is also the phone number that you can call and text me at. And where do we find you, Matt?
I was going to say a joke, but I decided against it. You can find me online at Matt Wilson Mortgages on all of your social media things. Shoot me a friend request, whatever. Also on here, go to the comments section. If you've got questions, we'll answer them. So
yep, absolutely.
Let us know what you're asking. But yeah, find me at Matt Wilson Mortgages everywhere.
Awesome. And until next time, make your next move a smart move.